Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. India decides not to join the Regional Comprehensive Economic Partnership, paving the way for 15 other nations led by China to form the Trade Pact. The Reserve Bank of India introduces liquidity management framework for all non-banking financial companies. The rule is binding on all NBFCs from December 2020. The Supreme Court halts construction activity in and around the National Capital Region, puts onus on neighboring states to ensure that there is no crop burning to combat air pollution in Delhi. Bajaj Finance launches qualified institutional placement at a floor price of 4,019.78 rupees per share, is aiming to raise 8,000 crores, say sources. Tech Mahindra and Titan are the two Nifty 50 constituents set to report their earnings later today. Well, the world setup is looking solid. So if you just look at what the US markets did in last night, and the Dow surged to record highs. So now the Dow joins the S&P in being at record highs, 27462, about 114 odd points, and both the charts finally converging. So US markets are doing very, very well. The Asian markets and the indices, the benchmark Asian index has formed a golden cross pattern. This is when the 50 and the 200-day moving averages converge, and that usually is seen as a bullish sign. So if we needed further evidence of what the world is likely to do, there is some technical method out there which suggests that there might be some bullish perspectives out there. Nikkei is up about 1.5%, but the chart shows how the Asian screen is showing some signs of an uptick or a trigger point from where it could do more. And if that is indeed the case, then while the SGX Nifty is showing some bit of red, a minor red on the screen today, the global setup certainly seems to be positive. And we'll get to that. I just want to mark the one big piece of news that has happened, and we'll talk about that on First Word in greater detail. Since we are talking about the world, say in Asia, India has decided not to join the RCEP agreement. China, of course, has gone ahead and said that India is welcome to join whenever India is ready. But this is that big news, and we'll talk about that on First Word in detail. But what does all of this mean for the trade setup? I don't think this in per se has big impact on trade, but the fact that the global setup is looking positive only bodes well for stock-specific bets. Remember, now the index, having done so well in the last few days, is looking a bit tired. The focus is on whether stock-specific actions continue. Simply because after 7 continuous days of gains, you might believe that the chances of the index outperforming are a stretch, but because the globe is positive, people might be enthused to take large stock-specific bets, because that's been the order of the day, isn't it? The last few days, while the index may even have stayed flat, we've seen a number of stocks breaking out and then continuing to see buying, and which is actually a great sign. What to watch out for in the session today? Two Nifty names, as our headline suggested, Tech Mahindra and Titan coming out with numbers, and some other key numbers. JSPL, the stock of yesterday, comes out with numbers today. I dare say if the numbers are positive, let's see what happens to that stock. REC, Godrej Properties, very important stock from the real estate pack, and Berger Paints, arguably one of the most expensive stocks in general, and the most expensive paint stock comes out with numbers, as do Dabur and Apollo Tyres. So fairly decent set of mid-sized companies coming out with numbers today, all of which will be keenly watched out for. So do watch out for these names. And then amongst the stocks to watch on open today, Bajaj Finance, the BloombergQuint exclusive getting confirmed. The QIP has been launched. The floor price set at 4019. I think the discovery, there is also a price band which could go slightly lower. So what may happen is that you might find the stock maybe just taking a bit of a dip, if at all, in the first flash 1 minute of trade, if at all. But this should augur very positively for Bajaj Finance if indeed the demand for the QIP is to be believed. So let's wait and watch. Watch out for this stock today. Could be an interesting one. Yes Bank, I don't know what to make of this. It's a very small stake acquired by Rakesh Jhunjhunwala at 67 rupees per share in the bank. I wouldn't want to second guess what could happen to the stock. It's a difficult one, frankly. It had a very volatile movement in trade yesterday too, Yes Bank. Let's wait and watch what happens in the session today. Persistent could well turn out to be that mid-cap IT stock. For quarters on end, Persistent has failed to meet the guidance. This time around, it's actually done really well. They've beaten estimates. The IP revenues did extremely well for Persistent Systems in the session. And that's purely the result why the revenue beat happened. The better than expected growth and margins led to a better profit beat as well. To watch out for Persistent Systems. It's not a very liquid stock, but decently liquid, could see some reactions. BEL is the other interesting one, and TCI Express. BEL might react negatively and TCI Express will react positively, so let's wait and watch. Today on First Word, what do we have for our viewers? Well, Michelle Jamrisko of Bloomberg News tells us why India chose to stay away from the RCEP agreement. Next, Vishwanath Nair joins in to take us through RBI circular asking non-banking financial institutions to maintain liquidity coverage ratio. Yash then joins in to talk more about marquee investors Rakesh Jhunjhunwala, Ashish Kacholia and Dolly Khanna bought and sold in the last quarter. And Charlene joins us to tell why FMCG companies have chosen to give distributors credit. India has decided against joining the Regional Comprehensive Economic Partnership, a trade agreement backed by China and covering much of Asia. The Modi administration cited significant issues of core interest that remain unresolved. Bloomberg's Michelle Jamrisko joins us from Singapore to tell us why India gave it a pass. Michelle, what were the points of contention?
Well, good morning. Yes, it's certainly not a decision that India took lightly. After 7 years of negotiations, some 30 rounds of mid-level talks, this is something that's been in the works for some time. And I know myself and my colleagues around the region in this process have talked to a lot of the officials and the negotiators, and India has always come up as one that has been most reticent to kind of jump on board, in large part due to labor mobility issues. We know in the end that the tariff deadlines for removal of tariffs and the levels at which those would be removed were also an issue, as well as kind of a broader vulnerability, as Prime Minister Modi might put it, of the workers in India to an influx that they see it of cheaper Chinese goods. So all this was kind of at the core of the decision on Monday, even as in the final days, you know, we got mixed signals from officials out of India saying with varying levels of certainty that they could still sign. That didn't come to fruition, but as you mentioned, you know, China is still open to having India as part of the trade deal. So we'll see how that hashes out in the months to come. But still a long road ahead as they kind of figure out the final details and then work toward at least getting those 15 economies to approve the deal.
Yeah, now that, I mean, that was, well, in part going to be my follow-up question to you as well, Michelle. Now that India has opted out, will China be able to fast-track the agreement with the rest of the countries?
Right. It's a tough call. I mean, there's delicate politics, not just on the populist and kind of protectionist front, of course, which was at the heart of India's decision not to enter into this lightly, but in other economies as well. I mean, other partners have had issues around, you know, some of the similar issues that India has cited, as well as others. I mean, this is not an easy deal to come to with 15 economies that make up some 25 trillion as one combined economy. So there could still be issues in the months ahead. However, they are kind of working towards something that might bring all those economies together. So we'll have to see. I mean, it's 10 ASEAN economies, of course, and then China, Japan, South Korea, Australia, and New Zealand. What complicates things now, too, is that with India's departure, that kind of gives it less of course, with the size of India's economy, but also with the political nature of it, it gives it less of a reputation as a pan-Asia Pacific deal and more of a China-led one, which is something that some economies might have a problem pitching back home.
Yeah, well, you make a fair point, too. Thanks a lot for that, Michelle. Thanks for joining in and giving us that perspective. You know, I must bring on board what the CII study on RCEP was. And I think CII believed that a large section of the Indian industry and the CII as a representative of that expressed some serious concerns about RCEP, about joining RCEP on basis of what they believe were genuine reasons. And you know, some of it outlined in the story on BloombergQuint.com as well. If you log onto our website and try and read the story on the homepage, it tells you about some concerns that India had. Shopkeepers, small industries, and the flooding of Chinese goods predominantly that would happen. The studies done by various Indian bodies seem to suggest that some concerns needed to be taken on board. Back home, the industries would be happy that this step has been taken or the concerns have been put on forth. And never mind that this hasn't happened as of now. In the words of China itself, whenever India is ready, it can join the agreement as well. So keep that at the back of your mind, that while the global view might be that India is not being seen as a pan-Asian country, domestic industries back home express serious concerns about India joining in on the terms and conditions that were expressed. Just one small piece to this as well is the US view out there, and I was reading the Bloomberg articles before doing the show, before starting the show. And America is saying that this is not even much of a trade agreement, it's just a very basic agreement. And naturally they would say that, but this would not sit well with the United States of America. So let's wait and watch how that goes about as well. Okay, from the global to local, the Reserve Bank of India has released a new set of guidelines for liquidity management at NBFCs. A framework intends to introduce a liquidity coverage ratio of 100% for certain large NBFCs in a phased manner and limit the asset liability mismatches in their books. Vishwanath Nair has this report.
The Reserve Bank of India on Monday released its final guidelines on the liquidity management framework for the non-banking finance system. Remember that back in May, the Reserve Bank had released a set of draft guidelines. So the final guidelines are pretty much similar to what the draft guidelines such as just suggested, except certain minor changes in the way it can be implemented in the NBFCs. First and foremost, the most important part of this entire liquidity management framework is the introduction of an LCR, or a liquidity coverage ratio regime for the NBFC segment. Here, the Reserve Bank of India has said that NBFCs will have to maintain, at least the larger ones, will have to maintain a 100% LCR ratio. However, the implementation of this will be in a phased manner so that it's easier for the NBFCs to adhere to the norms. Currently, banks already are following a 100% liquidity coverage ratio regime. For NBFCs, the process of maintaining 50% of LCR will start in December 2020, and by December 2024, the number will have increased to 100%. So what exactly is consisting of this LCR? Well, these are high quality liquid assets which the NBFCs will have to maintain. The RBI has given specific directions to the NBFC as to what qualifies as a high quality liquid assets. This includes, of course, cash and government securities and any marketable securities which are not issued by banks, NBFCs, or any of its affiliates. Remember that as part of this entire framework, the NBFCs can use the liquid assets when they are in severe financial stress. What the RBI qualifies as a severe financial stress is a set of parameters. Essentially, if the NBFC is facing a runoff of a high proportion of its deposits, or there is some kind of partial loss on the unsecured credit that it raises from the market, or any partial loss in the secured debt that it raises from the market for short-term financing, as well as any kind of contractual flows that may happen from the NBFC's cash position because of a rating downgrade. All of this qualifies as a severe financial stress situation, and in these situations, the NBFC can use these high-quality liquid assets and maintain its liquidity position. However, it will have to write to the RBI and clarify why it is doing this and how it intends to correct the situation. Apart from the liquidity coverage ratio regime, the NBFCs are also required, or the boards are also required, to come up with a airtight framework which will ensure that the liquidity position of the NBFCs is monitored regularly, and there are specific steps with respect to how the governance of this liquidity management framework is taken care of. With respect to the mismatches in the asset liability position of the NBFC, the RBI allows certain deviation in the short-term side of the liquidity position. So essentially, if the liquidity is between 1 and 30 days, so there, depending on the bucket that you're in, it allows about 10 to 20% of negative deviation. This is essentially to make it easier for the NBFCs to adhere to these norms. Apart from this, of course, the NBFCs will also have to disclose certain key parameters such as funding concentration, or the top 20 large depositors, the top 10 large borrowers, as well as funding concentration based on significant instruments or products, as well as the NBFC's exposure to CPs, NCDs, and other short-term liabilities. So all of these will have to come out in the form of disclosures by the NBFCs. Now, a liquidity management framework was necessary for the NBFC segment, primarily because of what happened last year with the IL&FS group. After that group had collapsed, there was a virtual freeze in the market, and NBFCs were not able to raise funds. So in situations like that, how will NBFCs manage their liquidity position and stay afloat? Well, this is the RBI's answer as to how they're supposed to do that and how they can continue doing their business even in stress situations.
Okay, so that's on NBFCs and the new guidelines, or partial new guidelines thereof. Moving on to, well, something that the market really loves to watch. Indian equity markets while it put up its worst show in 6 quarters in the 3 months through September, and slowing the domestic economy and geopolitical tensions all hurt returns. But veteran investors, and 3 of them, Rakesh Jhunjhunwala, Ashish Kacholia, and Dolly Khanna, use this as an opportunity to optimize their portfolios by tweaking their holdings. Yash Upadhyay is standing by with what they bought and sold last quarter. Yash, good morning.
Morning, Neeraj. So it was a busy quarter for the big bulls. So I'll start first with Rakesh Jhunjhunwala, and he has increased his holding in 7 stocks. Right at the top is Jubilant Life Sciences, TV18 Broadcast, Agrotech Foods, which is the maker of Act2 Popcorn, NCC, Rallis, VIP Industries, and Federal Bank. Now, the most important one that I want to highlight over here is Jubilant Life Sciences, because this is for a second straight quarter wherein we have seen Jhunjhunwala increase his stake in the company. He's increased it the most by over 1.5% in the September quarter, taking his overall holding now close to around 3.5%, which is more than double to what it was, close to around 1.6% at the end of the March quarter. Another name that is Agrotech Foods. That is also one of the other companies wherein he has added to his holding for a second consecutive quarter. It stood at close to around 7% as of the March quarter and now has increased to almost 8.22%. So these are the two companies wherein he has substantially increased his holding for 2 successive quarters. But that apart, key names to watch out for are TV18 Broadcast, another one close to 1% added in the company, as well as NCC and Rallis 0.5% each. A bonus to this list is obviously the one that came out in news yesterday, when he has bought close to 1.3 crore shares, or almost 0.5% stake in Yes Bank. It may feature in the shareholding pattern in the next quarter, so that is something that we'll have to watch out for. But on the other hand, while he has increased his holding for 2 successive quarters in Jubilant Life Sciences, he has reduced his holding for 2 successive quarters in Lupin. So he has picked on, he is taking a liking to one pharma company, but the other one is seeing selling. Only about a marginal 0.15% cut, cutting down in his overall holding in the September quarter. But for 2 quarters, we have seen him reduce his total stake, and it now comes down to 1.56% from nearly 2% 2 quarters back. That apart, Titan is another name wherein he's reduced his holding by about 0.5%, as well as the likes of Ion Exchange and First Source Solution. But these are just minor adjustments to his overall holding. That apart, let's also take a look at the holding changes for Ashish Kacholia. He usually invests in mostly the mid-cap and small-cap names. He has added 2 new companies to his portfolio, and they include the likes of MSTC, where he's bought an almost 1.27% stake. It did come out with its IPO earlier in the year in the month of March. It wasn't one of the greatest of the IPOs. It was down close to around 25% just a quarter before, and then we've seen it rally, and it's almost flat so far on a year-to-date basis. Apollo Pipes is another name wherein he's added close to around 2% stake in the September quarter. But that apart, he has also increased his holding in a few companies, and they include the likes of DFM Foods, Majesco, and KPIT Technologies. Now, these are all the 3 companies wherein he had increased his holding in the previous quarter as well. So for 2 consecutive quarters, we are seeing buying come in for the likes of these 3 names. Obviously, he's increased the most in DFM Foods by almost 0.6%, as well as 0.5% in Majesco. So the 2 mid-cap IT names, Majesco and KPIT Technologies, where he's added, and DFM Foods is one more name to watch out for. But on the other hand, he has also reduced his holdings in almost 5 other companies. But Merck Electronics is one that stands out because he has reduced his holding by over 1% in the consumer durable maker, and minor adjustments to the likes of Hykel, as well as V2 Retail and GTPL Hathway. Birlasoft, his holding now stands below 1%. That is also one of the names to watch out for. But the key name over here is Merck Electronics, where his holding now comes down to almost 2.17%. Lastly, let's take a look at the portfolio changes of Dolly Khanna. Obviously, it is Chennai-based investor Rajiv Khanna who invests in his wife's name. It was a rather quiet quarter for him because neither did he add any new stocks to his portfolio, nor did he add it to any of his existing holdings. But he used this opportunity that the markets gave in order to cut down on some of his existing holdings. And again, for a second consecutive quarter, we've seen these 3 names come in the form of the likes wherein he has reduced his holdings. So again, Neel Kamal Limited, as well as Rain Industries and Nosil, all these 3 names were in the June quarter as well, when he had to reduce his holding. Again, close to around 0.5% to 0.3% in these names in the previous quarter as well. And this time again, a 0.3% stake gone in Neel Kamal Plastics, bringing it down to 1.18%. Close to about 0.1% in Rain Industries as well as Nosil. So minor adjustments seen there for Rajiv Khanna as well.
The interesting one, Yash, seemed to be and Ashish Kacholia, Apollo Pipes. It's a large institution-backed stock, and there is some increased traction out there in that segment, and Apollo Pipes is seeing some buying there.
Right.
Yeah, okay. Let's wait and watch what happens. Thanks a lot for that, Yash. So, a story around this on the website as well, BloombergQuint.com. Most of the things that we do feature on the website, but keep in mind, this one in particular, published yesterday. Do log on and try and read more about this on the website. Okay, the last piece on First Word. The liquidity crunch with distributors has prompted FMCG players to give them some leeway. A BloombergQuint survey conducted amongst distributors across the country suggests that the manufacturers have decided to extend some credit. Charlene D'Souza has been speaking to stockists, joins us now with the details. Charlene, good morning. I remember for the previous quarter, when we were talking about what distributors are saying, they were feeling the pinch. Now there is some remedial action being taken by the manufacturers, I presume.
Yeah, so as the demand slowdown continues, consumer goods companies have started to accept delayed payments from distributors, which is never really the case. They always take an upfront payment, as soon as they deliver the goods, or in fact prior to even delivering the goods, they first accept payments and then deliver the goods. But now they are taking the payments with a delay of 5 to, and in some cases also 15 days. Now, companies have also accepted it and have, like HUL told its investors that in some select cases, they've stepped in to support distributors through credit, and they've done it during the quarter and also during the end of the quarter. Now, however, USL, that is United Spirits, Anand Kripalu told its investors that, yes, there is a cash crunch in the system, but they will only supply stocks if you take the stocks. They will not support, give credit to distributors in order for them to actually, ease concerns in the chain. So he said that while somebody else may have pressure on the top line, I'll take that risk. Let me supply and deliver my quarter numbers. Now, across the country, let's see how the situation has panned out, because companies have taken a different call depending on how the demand scenario has panned out. In West, in Mumbai, we've seen that, companies would take upfront payment, but are now giving distributors time to pay. It's between 5 to 15 days. In Goa, the distributors are saying that companies are actually opting for these measures because they have to, meet their targets. So especially on the last bill that is, generated in the quarter or the last bill of the month, because they need to show in their sales. So they get the required, permissions, and they go ahead and do this. Also this is the time that they make distributors take more stock at that point, because they need to show it in their sales numbers. In East, Odisha, companies are not yet doing it, but in West Bengal, companies are extending a credit of up to 5 days. Also, what they've done is in the last 1 month, they haven't increased the target. Usually month on month, they actually increase targets by say 5%, 3%, 7%, depending on how. But now the pressure to actually increase targets on the distributor, to take up more stocks is actually not the case. In North, the distributor in Punjab also said that, credit is between 5 to 7 days, and, in some cases, it's also going up to half a month. But smaller firms or smaller FMCG companies are also willing to accept staggered payments for the bill. In Uttar Pradesh, companies have extended credit to the extent of 7 days and are not forcing them to push stock. We need to understand one thing in North India. North India is the worst affected area in terms of the demand slowdown. However, South India, which is the least affected, in fact, as per Nielsen's figures, the July-September quarter, we only saw demand actually, move down by 0.7%. No extension of credit payments were done in order to boost, to distributors in order to push for stocks and trade. So that is what we saw in Telangana and also in Karnataka as well.
Okay. Charlene, I think somebody tweeted this about a liquor major on the earnings call. I'm guessing it would be USL, who said that in order to minimize the credit risk, they will not push sales aggressively. But the fact that liquor trade is facing big time liquidity crunch, and there are some similar feedbacks by the FMCG companies as well. Are dealers in any fashion talking about any expectations about when would these credit pressures ease off? Because I think I've been now hearing this about these credit pressures for a while now, at least 3 quarters, if not more.
Yeah, but this is the first time in the last 1.5 months that companies are actually willing to take a step towards in that direction.
Helping them.
Yeah, and are taking, a call to, in fact, ease off the pressure, not push targets, give them an extension on payments because they know that there's a cash crunch in the system. Now, what we've been given to understand as per Nielsen's figures is this demand slowdown is going to continue till the end of 2019, calendar 2019, 2020, the first quarter, January to March, that is when we'll see some amount of spurt. But whether companies will still push at that point in time is what we need to still wait and watch. But at this point in time, companies are definitely, still extending credit, and this is something that no company has actually, no distributor, at this point in time has said that, companies are just doing it as a remedial thing in the short term. They have not given any indication as to when this will come to an end.
The question is whether it will help volumes in a meaningful way, or will volumes get impacted in quarter 3?
That is what we'll have to wait and watch, because the demand for the festive season already went into Q2 because of although the festive season comes in, but distributor push into
took
the
in
trade
earlier.
Yeah.
Oh, great, good stuff, Charlene. Thanks so much for bringing this to us. Well, it'll be very interesting to see if the quarter 3 volume numbers for FMCG majors, or all consumption names largely, face a bit of a challenge, and whether it is in the expectations or not, we'll get to know. That's all that we have on First Word today, though, but lots more lined up on Indian Open today. KK Mistry of HDFC talks about what's aided the mortgage lenders' earnings in quarter 2. Andrew Holland of Avendus Capital, Johnson on Market, open to talk about his thoughts on what's happening. We speak to TCI Express Chandra Agarwal on earnings and how the festive season's panning out for them. It's been a robust quarter. Be interesting to talk to Chandra. And then we speak to Christopher O'Connor of Persistent Systems about earnings. They have recorded a healthy beat. Be interesting to get Christopher's views. But after this break, a full tilt towards the day's trade.